Have you ever placed a trade only to see the market going on the opposite direction? I mean, that's a very basic question, right? Of course, it happens all the time. But understanding market structure is the key to reading price action like a professional trader. Well, in this video, I'm going to be breaking down everything from the basics to the advanced market structure concepts so that you guys can confidentially analyze the charts, take trades, and spot profitable trade setups. So, what are we still waiting for? Let's get started. Now, what is market structure? So basically, the definition of market structure is how price moves and forms patterns on the chart. A very simple and basic definition of market structure over there. So, what are the three basic structures that price forms? The first one is the uptrend, downtrend, range, or consolidation. What is an uptrend? An uptrend basically is price moving up. Like the name suggests, uptrend, price is moving up. So price is moving up in series of higher highs and higher lows. Okay, in a downtrend, it does the opposite. Price moves down. Price moves down in a series of, or creating a series of lower highs and lower lows. Okay, in a range or a consolidation market, you want to see price moving between support and resistance zone. So basically, price is moving on a sideways movement. Okay, now I'm going to be showing you an example, a basic example of how the structure is being formed throughout the market. So let's scroll down over here and see this example that I drew for you guys. Now over here, what is this? This is an uptrend. How does an uptrend form? Remember, we say that an uptrend forms when price is going up in series of higher highs and higher lows. Okay, so that's basically an uptrend. So an uptrend in this case, you can tell that price started from this. So this being our swing low. Okay, so price starts from the swing low, gives us an impulsive move. So when you see this vast move that goes up over there, this expansion over here, it's called an impulsive move. It gives us a swing high, which we call an higher high. Give us a corrective move. So this is a corrective move over here, or you can call it a bullback or a retracement. It depends on you. And then when it comes down, you want to see price coming down to the half of the impulsive move over here. Now that is called a corrective move. And when price bounces back from this drop or this swing low over here, this zone is called a higher low. Okay, and then the price goes up again to repeat the same structure again. Price goes up, gives us an impulsive move, gives us a swing high, we call that a higher high, give us a swing low, we call this a higher low. Basically the same concept. It's a very easy concept that I don't need to explain much for you guys, because basically you can see what is happening over here. Now that is an uptrend. That is how an uptrend is being formed in the market. Now let's go to a downtrend. How does a downtrend form? Remember guys, a downtrend is formed when price is going down in a series of lower highs and lower lows. Basically what price does in an example of a chart over here, we can tell that price is dropping down, giving us an impulsive move. Remember the expansion that I told you, the big expansion that you see after price is ranging. Okay, I'll get to that later on, but what I mean is, after an impulsive move, price gives us a lower low, and then when price goes up, it gives us a lower high. And you don't want to see price go all the way to closing above this high. You want to see price come back towards the middle of this passive move over here, something like that. Okay, that is called a lower high. And then the next thing price does, goes down, gives us a lower low, and you want to see price closing below the previous swing low. That is called a lower low. Gives us a lower high, which is the corrective move. So the corrective moves are the short momentum candles that are being formed that gives us an up close candles that closes in the middle of these impulsive moves or these huge expansions over here. That is called a corrective move. So you want to see price goes down in a series like that. That is a downtrend. Okay, hope you understood me there. Now, what is a range? If you remember very well, we said a range is price moving between support and resistance zones, or price is moving sideways. So price, you can tell that price is different from this uptrend and a downtrend. Price basically is moving in sideways over here. You can tell that nothing is happening. Price is just moving up and down, up and down. So basically, when price is above over here, when price is creating these highs, let me mark this with this. When price is being rejected over here, above here, we call this a resistance zone. Okay, because it's resisting. Basically, a resistance is price is resisting. It can't go up or break above. That is a resistance. And when price is not breaking the lows, we call this a support. So price is supporting at the downside, price is resisting at the upside. Now this qualifies to be called a consolidation or a range. Okay, and that is the beginner level of basic structure or market structure. Sorry. Now this is just a very basic approach towards basic sorry, why do I keep saying basic structure? Market structure. Okay, this is a very basic approach. Now, after understanding this, you need to identify these structures and align them very well to your trades, and you want to be taking these trades according to the trend. So basically what I'm saying is, whenever you approach something like this in a real chart, you want to be trading with the trend. So if you look at prices going up like this, it's giving us an uptrend. You want to be looking for opportunities to buy the market, and rather not to short the market. Short is like to sell, long is to like buy. Okay, and the opposite, when you see price is giving us a structure like this, or giving you a structure like this in the market, you don't want to be looking for long positions. Don't be manipulated by these corrective moves that I've talked about, that most of the traders will be like, maybe this price is going to be reversing or something like that, and they get caught in the market and they end up going on a huge drawdown, losing their accounts, blowing their accounts literally. So when price is going down, you want to be looking for opportunities to sell and rather not to buy. That's basically what I meant. So remember guys, never ever fight with the market, or in short form, never ever trade against the market trend. Okay, cool. Now let's head over to the advanced market structure over here. So in advanced market structure, basically, okay, first of all, let me move this over here so that you guys can see. Now, as you advance in trading, understanding market structure goes beyond just the trends that we talked about earlier on. Okay, so here are the key advanced concepts that you need to master when approaching the market. Now, approaching the market in a way of trading the market and not just analyzing. Analyzing and entering your positions. So that comes to another topic of advanced market structure. Okay, now when you're taking these trades, there are some concepts that you need to first of all understand before taking the trades, and these concepts are, so I'm going to be mentioning them, and then I'm going to be explaining them later on, and then I'm going to be showing you the examples of the charts, or examples of these concepts in a real chart. Okay, so the first concept is called a break of structure. So that's the first concept. The second concept is basically liquidity sweeps. The third one is fair value gaps and breaker blocks. So what is a break of structure? A break of structure simply means price or the market is signaling a potential trend reversal or a continuation. So it tells you if price is trying to reverse. If it was an uptrend, it's trying to reverse to a downtrend, or a continuation. Continuation is basically price is going to continue the trend, which was the direction that the price was going from the beginning. If it was an uptrend, it's basically continuing to the uptrend. That is what a break of structure means or indicates in the market. Now, let me show you an example of break of structure. basically you already see how a break of structure um, looks like in the chart. Okay, so remember the move, the uptrend that we talked about. A break of structure forms when price breaks above the previous higher high. So when you see price breaking above the previous higher high with an impulsive move, remember we called this an impulsive move, remember that. So an impulsive move is being formed with series of up close candles closing above the previous higher high. That qualifies to be called a break of structure. So it signals you that price is going to continue going up. So break of structure over there, break of structure over there, break of structure over there, break of structure over there. That's exactly what a break of structure means. It's very easy, a very easy one. Okay, in a downtrend, here's how a break of structure is indicated. So after an impulsive move, a corrective move is created, and then the next thing is being created is an impulsive move. So an impulsive move indicates that price is going to continue going down when you see this a lower low being broken. Okay, this tells you that price is going to continue dropping. So the next thing that you're going to be waiting for is price coming back, giving us a corrective move, and then this is where we'll short the trade or we sell towards the previous lower low, and then that becomes a break of structure. The same thing happens, continuation, just like that. So that is how a break of structure is formed in the market. Now, the next thing is liquidity sweeps. So what is liquidity sweep? So a liquidity, first of all, is let me explain it this way. Liquidity is like where market makers hunt or where traders, so liquidity is how where traders place their stop loss. Okay, I don't want to make this complicated. Liquidity is where most of the traders, basically to be specific, retail traders like you and me, place their stop losses in the trade whenever they are taking the trade. So for example, let me show you an example of this. Assume this was a market like that. There was a market like that, and price has been ranging. So price has been giving us a consolidation move over here. Okay, let me use this one. Price has been moving up and down, up and down, up and down. Okay, and then a retail trader will be looking like, okay, price did break out of this low, and then price is coming back. So basically, this is a corrective move, right? Impulsive move, break, corrective move. So a retail trader will be like, okay, I'm going to be selling the markets at this place. Okay, so what the market does is that it goes down like that, but the next thing is going to happen is that the price is going to go up, take out the liquidity that was ranging above these highs, and then the main move to the downside happens. So basically, this is how a trader does. You will enter the sell positions over here, place their stop loss above this high, and then go for their take profit over there. Okay, so the liquidity that is lying above here, there is liquidity that is lying above here. So we call this a pool of liquidity, which is buy side liquidity. I'll explain that in another video. Okay, okay, that's the sign, just a dollar sign. Sorry. Shift. There we go. Yeah. So this is how our liquidity is indicated. So price, there is buy side liquidity that is lying over here. So price goes up, takes out the liquidity over there, and then the main move to the downside continues. So where the place there you should be taking the short positions is somewhere after price takes out liquidity. This is where you enter your short positions, place their stop loss there, and then go for the short position. Okay, so that is what basically liquidity is. Now the process whereby the liquidity is being swept like that is called a liquidity sweep. Sorry for that. Okay, liquidity sweep, price is taking out the buy side liquidity, and then the main continuation. Okay, yeah, so that is what basically liquidity is. Market makers okay, market makers hunt liquidity before a major move in the market. So basically just know that one. Whenever you're taking any trade, consider first of all price taking out liquidity before the main move happens in the market, like I indicated over here. So this is basically what happens. Price give us a range, remember a consolidation, price is moving inside a resistance and a support. And then the next thing price does is that it goes up beyond the support or the resistance. Now that we call a liquidity sweep, because the liquidity that was above over here has been swept, and then the main move occurs. That is just how a liquidity sweep is formed in the market. Now the next thing is fair value gaps and order blocks. So fair value gaps and order blocks, these are institutional levels where price reacts, basically point of interest, where price always respects before the main move occurs in the market. So when price gives us a break of structure in an uptrend like this, price gives us a break of structure, the corrective move that is being formed, the price will come down to, like I said before, half of the impulsive move. Price respects the fair value gap, the bullish fair value gap that was formed, and then most of the time you will find order blocks lying beneath the fair value gap. So over here we have an order block. So price comes down to this point of interest, to these institutional levels, and then it reacts towards the main move, which is, it gives us an impulsive move. So this is where most of the retail traders enter their long positions. Okay, so buy the market. Okay, so these are where they place their trade, place their stop loss, go for the previous high over there, just like that. That is basically how you enter the trade after price fills the fair value gap and then respects an order block, and then that is where you buy. The same thing happens. Okay, and in a downtrend it's the same thing. Price gives us an impulsive move, corrective move, price respects the bearish fair value gap, and then above the fair value gap always lies a bearish order block. So price respects or taps into an order block, and then that is where you want to be selling the market. So you place your stop loss above here, and then you always want to target the previous lower low over there. That is how you should be taking the trades while trading this market structure over here. Okay, very simple, very simple. What do you call this? Strategy that you need basically whenever you are starting trading. So I don't know if you are a trader and you don't know basically what I'm talking about, because you can't trade without knowing these things, this stuff over here. It's a very simple and friendly market strategy that anyone can master, basically even a 3-year-old child. Yeah. So another thing that I want to cover over here is breaker blocks. I've not covered the breaker blocks yet. So a breaker block, what is a breaker block? A breaker block is defined as failed order blocks that become key support or resistance zones in the market. So whenever an order block has failed, whenever price doesn't go up, basically like this one, price never went up to target the order block and basically the fair value gap, maybe that was here. Whenever price does that, that is called whenever price fails to tap into this order block and comes into a fail. So this one over here is the breaker block. So at this point of time, whenever price breaks the lower low turns into an order block or a breaker block. So whenever price comes back to this zone becomes a breaker block. Why do we call this a breaker block and not an order block? Basically, if price is broken, if price had broken this low like this, like that one, and then price immediately comes up and fills this gap before continuing dropping down, that would have been an order block. But price did drop down with huge momentum like this, and then price came back later on, fills this previous lower low that was here. Now this qualifies to be called a breaker block. So it's a failed order block that becomes a key support or resistance zone. So now this one acts as a resistance. So this basically now is a resistance. So you don't want to see price go above this high over here. Sorry, this resistance that has been formed, which now is being called a breaker block. So that is how a breaker block is formed in the market. Basically very easy, right? Yeah. So now that we understand market structure, let's apply it into real trading example on the chart over here. So this over here is US 30 Dow Jones. So we want to be using examples of the trade that played out on US 30 to refine our entries and identify the how market structure is playing out. Okay, now first of all, pause. Traders, I see a lot of you guys watching and enjoying these videos, but guess what? Man, most of you aren't subscribed yet, and if you're finding value in this content, hitting that subscribe button really helps this channel grow and pushes this video to more traders, to more beginner traders who might need them. And we're on the road to 50 and then to 100 subscribers, and every single sub counts. So if you want to stay ahead in the markets and help others do the same, please hit that subscribe button now and let's grow together. So the first step, that is step 1, is you need to identify the overall market trend. If the market is on an uptrend or if the market is on a downtrend. The second step that you need to find is you need to find the key structural points. These are the highs and the lows, and also the liquidity zones in the market using a higher time frame. The third step is you need to look for confirmations. These are you want to be waiting for break of structures, change of characters, and liquidity sweeps to occur. First of all, the last step, which is the step 4, is you need to be executing with smart money concepts. You want to be entering at fair value gaps, order blocks, and breaker blocks when we want to be using proper risk management. So let's get straight into this example that played out on your study. So looking at your study, you can tell that this was our swing high and this is our swing low. What is the first thing that we want to be looking at is, like I said, the step 1 is identify the overall market trend. So what is the overall market trend? So if we look at the left, you can tell that your study had been dropping, and after price dropped, we can tell that it did drop, but then the next thing price does is that price started going up and breaking the previous swing high that was supposed to hold. Price wasn't supposed to break over here, so that becomes our change of character. So this is where we start looking for opportunities to buy because price has taken out the previous swing high. Now, so this is an example of an uptrend. Okay, so in an uptrend, sorry for that. Oh my god. Okay, in an uptrend, price basically does this, right? So after price breaks this high, we want to start analyzing from here. So price gives us a break of structure over here. So this is a break of structure. Okay, where is this? I have a lot of break of structures. Yeah, that is a break of structure. Then price gives us an impulsive move, which is our expansion. And then when price drops down, price comes back towards what? If you remember this was a fair value gap. So this is the fair value gap. So price comes back to fill the fair value gap. And then if you see over here, you can tell that over here we had an order block. So let me mark this order block. So where do we want to enter the trade? We want to enter to trade after finding the key structural points. Our structural point over here is after price breaks structure, we want to see price come down to fill the fair value gap. And if you concentrate your focus over here, you can tell that price had been on a range or on a consolidation before price dropped down. So this was a range. Okay, that was a range. And then if you remember very well what I said about liquidity sweep, price drops down and takes out the liquidity that was lying between or below this line over here, which is our sell side liquidity. That this is the liquidity. Okay, so let me mark this X. Okay, just know that there was liquidity that was lying below this. I can mark that. I don't know why this is taking a lot of time. So there was liquidity that was lying here, price swept, and then price fills the fair value gap, and this is where we enter a long position. So this is where we long position, place our stop loss below this, and then we want to target the previous break of structure or the previous swing high, which is gonna be here, and this we mark this our break of structure. You see, just the same thing that we were analyzing. So this becomes our break of structure. I have a lot of confusing concepts. I don't know why I marked a lot of this. So this is our breakout structure. Okay, where is this? BOS, there we go. After that, what do you see here? You see another thing too. Price gave us another breakout structure over there. And then the next thing we want to be looking for, okay, I don't know why this is happening right now. This is the breakout structure. I need to delete this one so I don't get confused. There is a breakout structure. The next thing we want to be looking at is a fair value gap. So over here we have a fair value gap, and below the fair value gap we have an order block. So this, we mark this an order block. So where do we enter our entries? We want to enter our entries after price has filled the fair value gap. So price fills the fair value gap, ranges, and then the next thing it does is fills the fair value gap once again, and then it dropped down, then it gave us this huge move. So this is where we enter our long position. Place our stop loss below here, and then we want to go for, okay, so if you don't have a previous high to be broken, you want to be targeting 1:2 risk to reward ratio. So this is how you look at here. These are our risk to reward. So you want to place stop loss here, go for 1:2 risk to reward like that. Okay, you can see how our buy structure is forming basically. Okay, now another one. Okay, what do we see here? Over here, price has been in an uptrend, and then price came back to this high and this low. So basically this one, this is our swing high, and price is failing to break above that, and this is our swing low. Price is also failing to break it below this low. So this qualifies to be called a range. So this is an example of a consolidation or a range. So let me make this now. So the next thing, if you remember very well, like I said, whenever we are in a range, we want to see price grab liquidity first of all, and then price give us an expansion. Okay, so price has been ranging over here. You can tell that price has been creating lows. Okay, price has been creating a low, low high, lows, highs, right? Okay, this is equal, this is equal, this is the same. And then the next thing price does is that price drops all the way down. Now this is not a breakout structure, this is a manipulation, this is a sweep. So this is the liquidity sweep that we were talking about earlier. And then, like we said before, whenever we see price giving us a liquidity sweep, we want to trade against that liquidity sweep that price did form, because that is a manipulation. So after price gave us a liquidity sweep, you can tell that to the left we had a volume imbalance. Okay, so a volume imbalance, just for now, because we're talking about basic market structure, so I don't want you guys to complicate this. Okay, so think of this as a fair value gap because it's a gap. Okay, but this is called a volume imbalance. So price feels the volume imbalance, and then price expands above. So this one over here, let me move this. So this is a volume imbalance. Okay, let me move this between this candle and this candle, this is a volume imbalance. So price drops down, fill the imbalance, give us a liquidity sweep below these lows after the range, before the range. Okay, after the range, yeah, after the range, and then the next thing price does is an expansion. So where do we want to be entering our position? After price gives us a liquidity, we want to see price repeat the same form, but after price gives us a breakout structure or a market structure shift. So we want to see price break above this previous high. Now that's where we're going to be entering our long position. So we'll call this a breakout structure or a market structure shift or a change in state of delivery. So price breaks this is where we enter a long position. Place our buy here, place our stop loss at the previous swing low. So there was this candle, so you can place your stop loss there and then go for the previous high, which was over here. And that's how you get your profits, just like that trading market structure in a bullish trend after price gives us a liquidity sweep. So this is an example of a range or a consolidating market. Okay, now we want to see an example of a down move or a downtrend. So over here Price has been ranging really. Price has been ranging between this high over here, this high over here. Okay, let me use this one. There's this high and there is this low. Okay, where is the low? This high. Okay, I think, okay, no, I think I confused it. I thought this was the same with this one, but it seems like price had already dropped. Okay, never mind. I just saw my things there. So an example of a downtrend is when price does this. Now when price has been going up, right? So where was our swing high? We want to mark our swing high. So our swing high was over there. Okay, so price has been ranging at this level until when price came back to our resistance. So this is our resistance level. So this over here is our resistance level. So price taps into the resistance level, and then the next thing price does is it give us a liquidity sweep at the resistance level, and then the next thing it does is that it breaks the low. So this was the higher low in a market structure, in a bullish market structure form. So this price breaking above this, we call this a market structure shift. Okay, so when price gives us a market structure shift, it gives you an idea that, or confirmation that price is going to be continuing going down. Now price is shifting into a downtrend. Now price, after giving us this market structure, the next thing we want to see is a corrective move, right? So price gives us this huge impulsive move, this one over here, this huge impulsive move from this swing high to this swing low. Now we wait for a corrective move, and we want to see price go all the way up, which it gives us here. So it gives us a corrective move, and then price continues going up. So whenever we want to trade on a corrective move, remember you say that we want to see price reacting off an order block or a fair value gap. But at this case, we can tell that there was actually, I wanted to say there was no fair value gap, but right now I'm seeing a fair value gap. So if you zoom in over here, I want you guys to see. So over here, you can tell that between this candle and this blue candle, this white candle and this blue candle, there was a gap that was in between them. So that is a fair value gap. Okay, what is this? Fair value gap. Now we extend this fair value gap, but what do you see? You can tell that price did fill the fair value gap, and this candle over here is the order block. So price did almost, actually it did tap into this order block. So this is our order block. So you want to mark all the candle, including the wicks. That is the order block. So price fills the gap, fills the fair order block on a corrective move. Remember, now that is where we want to sell the position. You wait for this candle to close, and then that is where you're going to short the market. So you place your trade there, place your stop loss above there, and then you want to be targeting the swing low. So over here we had our swing low, that's going to be our take profit. So you place your take profit over there, but you can tell that the risk to reward is 1:6. So if you include risk management on this, you remember you want to be risking 1 to at least get 2, for that, so that you can literally trade and get some profits, right? You can't be risking 1 to get 1. That is not trading. So you want to be going for 1:2. There we go. Okay, over here 1:2. That is a good trade. Okay, another example, after price did drop, you can tell that it gave us a swing high, a swing low, then price goes up. Now when you see this is not a break of stocks. This was our swing high, remember, this is our swing low, and then we want to see price give us a corrective move that doesn't close above this high, but you can tell that price did go all the way up here. So I want to measure on this. So whenever you see this, first of all, you need to consider or look at how the candlesticks are forming at this period of time. You can tell that price didn't break with this, or with candlesticks closing above this high. You can tell that price closed with wicks and not with bodies. So price gave us these wicks, so I won't consider the wick. So price gave us this, so it came back to this low high, and then immediately started reacting off there. So this is going to be the liquidity sweep that we were talking about earlier. So this was where liquidities was lying. So we're going to be calling this a buy side liquidity. Okay, liquidity over there. This is going to be our liquidity. Okay, so price did take out the liquidity this week, and then how do we enter the trade over here? We wait for price to break a previous low. So when after price did give us this week, price came down and broke this low. Now this becomes our market structure shift or break of structure. So let me call this break of structure. So price did drop, so you don't want to be selling at this point of time. Okay, it depends on you. If you are early on the trade, you can take your sell positions immediately at the price closes below this, so you can take your stop loss there, go for 1:2. But if you are patient enough, you can still wait for price to test out this order block. So if you measure over here, you can tell that price had created an order block over there. So this was an order block, and if you see here, we also see there was a fair value gap between this candle and this candle. Was a bearish fair value gap over there. So what price did is price came back, fills the fair value gap with these huge bodies, and then it goes all the way for this order block that was above here. Now when you see this, that is where you want to be entering your sniper entry. Up the price closes with this huge body, and place your stop loss above the body, go for 1:2 risks to reward ratio. So that is 1:2. Okay, 1:2 right there. You see? So this is just how market structure plays out in a real chart example over here on US 30. Okay, now here is another example of a liquidity sweep. Price taking out liquidity before going to the main move, which is down. So remember, our bias over here is we are on a downtrend. That is our overall market structure trend, right? So after price gave us this swing high, let me mark this for you, this swing high and this swing low over here. So between this candle and this high and this low, you can tell that price came back for this high, but the next thing it does that it closes with these huge bodies, but the next thing it does that it came back for this low. So it did came back, and then so there, okay, I'll teach this in another video, but there's something called an inversion fair value gap. So in advanced fair value gap, whenever you are measuring on fair value gaps, whenever you see price run a previous bullish fair value gap, like price disrespects the fair value gap, you will consider this price is trying to change the market structure and start going to the downside. So price running over a fair value gap, inversion sorry, not this is not an inversion, price running over a fair value gap, that means that that fair value gap is not going to be holding. That means that price is going to be definitely going against that fair value gap. So whenever you see price running over this, what comes in your mind is price is going to continue going to drop. And if you see here, you had our liquidity over here that was swept. So this was our liquidity sweep. And then where do we enter our trade? We enter our trade after price breaks a previous low. So if you see here, this was not a low, this is not a valid low. So after price came back, runs the fair value gap, it came back again above here, and then it dropped. So whenever you see price breaking at this low, right, I call that a break of structure, that is where you enter our short position. Okay, that is where we enter our short position. If you are, like I said before, if you are not impatient, okay, most of the traders don't like waiting for the market to take all that time in the market and then waiting for price to come back over here. So you can take your short position immediately after seeing this. So you place your sell stop loss over there, and then you go for 1:2, and you can tell that that was a winning trade if you had taken the trade immediately. And if you are a patient trader, you can tell that after price did give us a break of structure over here, it had created a fair value gap. So over here we had a fair value gap over here, and our order block was over here. Let me make this with this horizontal. So this candle over here is our order block. Okay, So this is our order block. So although price didn't came all the way to the order block, you can tell that it did fill the fair value gap, and this is where you want to be entering our short positions. Okay, so impulsive move. This was our impulsive move, give us a low, and then corrective move, and then this is where we want to be selling the market. Sorry for that. Okay, good. This is where we're shorting the market. Immediately you see this, we'll be selling at this candle low, place our stop loss above this high, then go for, okay, go for 1 is to 2. As simple as that. That is how simple market structure is whenever you are taking these trades. Okay, so that, ladies and gentlemen, is the end of this video. So this is a complete breakdown of market structure for traders of all levels. So if you're a beginner or if you're a professional trader, I'm very sure that you have learned something throughout this video. Okay, so if you found this video helpful, please don't forget to hit that like button, subscribe, and then turn on the notification so that you won't miss out on the future trading content that I'm going to be posting. Please drop a comment below and let me know which trading topics you'd like me to cover next. So guys, I'll see you in the next video. Peace out. Peace out.